Hi, this is Jackie Ann Patterson, and today I am recording a video of my weekly market analysis. I thought I would share that with you up on the web, and there's probably going to be a whole lot of information coming at you, so I will go through it with a little bit of explanation on each of the indicators and data points that I look at, and then I can come back and answer more questions and record more background videos as I'm spending more time at home during these troubled times. Okay, so as I mentioned, my name is Jackie Ann Patterson. I've been writing a newsletter called Divergence Alerts for, about 10 years. And that started to be very much about MACD divergences, which is a technical indicator. And over the years, I've added more and more market status, trying to get an idea of what the broad market is doing. And so that's what I'm going to be sharing with you in this video. So I do actually use this information for my own trading, and I might hold positions in what I talk about. I can mention what I own at the time of this recording. Of course, that may change by the time you watch this. And this is entirely for educational purposes. It's not a recommendation to buy or sell securities. And I have depended on back testing to give me some insight into what are some decent strategies for the market. And I'll mention that as I go along too. But of course, that is not reality. And I certainly don't have a crystal ball knowing what's going to happen. And that's kind of why I do this discipline of looking at various indicators. If you have questions, please go ahead and enter them on the video below if you're watching in YouTube or on divergence-alerts.com. And I will do my best to get an answer back to you. So the goals of my weekend market status are to form an opinion on what's the market going to do in the short term and in the long term, and what do I want to do next week. And as I've talked about in email and in various presentations, the market can be pretty surprising. And I don't have a crystal ball. So the best that I think I can do is to understand what I plan to do based on what might happen in the market. And so that's kind of what this information goes towards. I take a systematic approach of looking through the same gauges each week and comparing them. Now I've been doing this for 10 years, so that's probably the value add that I have, is having seen what has taken place, had to make my best judgment at the right edge of the chart to what I want to do and what's going to happen next and how can I best limit my risk. Now this video is part 2 of 2. I already recorded a video about my ETF rotation strategy, and that is a very it is a very well-defined strategy with specific things to look for and specific moves to make. And that takes a lot of the decision making, and it at least takes the surprise of my own behavior out of that investment style. What I plan to record today in this video is tools for discretionary investing. By discretionary, I mean making the decision of what to do in a fairly open-ended fashion. Now, it's possible to create rules that bring together the various indicators, and of course, I have my rules on what I'm going to look at and how much I'm going to risk, and how am I going to decide when to exit from the market if it goes the opposite direction. But that is a whole lot looser and less clear than doing the mechanical investing. So the difficulties that we have to overcome in discretionary investing, of course, I've mentioned no crystal ball, and the best that we can do in the absence of knowing what's going to happen in the future is to look at what has happened in the past. And we can do that in terms of back testing a strategy. We can also do that in terms of looking at what an indicator has done in the past and how things came out. And the third thing I would suggest is to follow the market. to look at the trend, follow the trend, to if you're looking at the reversion from the mean, follow what the market's doing there. So um, I think that some of investing is really good followership, especially at the individual level. I mean, there's no way that what I do will move the market. It's much more the onus is on me to figure out what the big players are doing and follow them. Um, so one of the things about uh, analyzing the market is there's way too much data out there. And there's data in various indicators, there's data in various media outlets and television shows and websites, and there's just no end to the information. So it's important to make a decision about what you want to look at and to stick to that, and to remember that getting more of the same information doesn't make something more true or more likely. It just makes you feel more comfortable with it. So it's important to manage our brains effectively as we go through all of the market data. So I look at a lot of indicators, both technical and fundamental, which I'll be going through. And rather than spend a lot of time on introduction here, I thought I would just line up what would be the best case time to buy. And take this with a grain of salt, because whenever I see all of the indicators line up and everything looks like a buy signal, almost invariably the market has turned the other way. So everybody who's waiting for a certain signal must have already gotten in, and then it's turned. So I take it with a grain of salt, and I'm probably more looking for the mixture of signals and where I can get a glimpse that there's a balance is shifted from one side to the other. And of course, where do I see a divergence where the price is going one way, but the indicators are showing us something else? So kind of to summarize this slide on the best case time to buy would be seeing the early part of a trend moving up, seeing upside breakouts, positive divergences, coming off of a market that's been beaten down and oversold. The calendar, we're coming up right now to a sweet spot being in October through December and before an election. Historically, the stock market has risen at times like this. When we're looking at sentiment, if we've seen a huge peak in the fear readings and then that subsides, looking at times when we've got low valuation and we're entering a period of economic growth, and if we're seeing widening yield spreads on the corporate versus government bonds, which is a way of saying people seem more likely to take risk. On the flip side, what is it that kind of shouts that the market is ready to go down? And by the way, it's got to shout pretty loud because the stock market is pretty much built to go up. So seeing these signals, again, it's kind of the when do you see the balance shift towards the market going down, and um, how hard do you want to play it? I have attempted to short sell the market, and that has not really worked out so well for me. So more I see some of these sell signals as a time to put on the brakes or build up cash or get to the sidelines rather than trying to jump in the other side. And then most of these things are the opposite of what was on the previous um, a slide, seeing a downtrend, seeing downside breakouts, seeing some negative divergences and kind of be careful with those, seeing things are overbought, um, coming into the quiet time of year, the summer after an election has happened, when people have gotten greedy and complacent and always think that the market is going to go up and the valuation is high because the market has gone up, and yet we're in a period of economic contraction and recession, and we start seeing the yield spreads narrow, which show us that the bond market, which is said to be smarter than the stock market, may be looking at some difficult times. So with this background, I would like to jump over to some websites Now, some of what I look at is on free websites, and some of what I look at um, are internal indicators or that either I've built or I've gotten in TradeStation. So this one is a free website, and you can, of course, see where I'm getting it from the Federal Bank St. Louis Fed produces these charts. This one is the 10-year Treasury bond minus the 2-year. So this is giving us the so-called yield curve. And looking at the right edge of the chart, the important thing is that it's above zero. So it has an almost perfect record. If I could expand this thing out, and I think even then, well, we're going back to 1980. So you can see the times that this yield curve has dropped down below zero. Um, that has been followed by a dark band, which has been when a recession has been officially declared. The stock market, usually prior to a recession, will go down. So having this activity below zero, some time elapses, and then the stock market goes down, and then the economists officially call it a recession. That is how things have worked in the past, and almost a perfect record on that. Occasionally, there's a little bit of a bounce down below, and then, oh, it takes a while for the recession to get going. So this is not an immediate indicator by any means. And you see that we had a little bit of a dip below zero. That was in August of 2019. See if I can zoom in on that. So teeny tiny drop below zero. And what do you know? Out of nowhere, we get this virus and the stock market tanks. And out of the reaction to that, economists are now calling it a recession. So we had this tiny bit of a yield curve inversion, and then it was once again followed by some difficult times on the stock market. So that kind of shows its track record, and right now, as I say, it's positive. So nothing really to do there. The next thing I look at is a valuation of the S&P 500, which is large capitalization, large company stocks, and how are they doing on their price to earnings ratio? Is the stock price high versus what they've been returning in earnings? And this chart, I hope you can see, goes back to 1880. And there's kind of a band of where the values have usually been. And then there's this stuff more recently, starting in 2000, where it goes up really high. And these have been kind of the bubbles and the crashes. And what do you know? We're up at a point that has never been higher except in a bubble and a crash. And we've kind of had the market go down so abruptly in the COVID crisis that I'm almost expecting this to go up to the point, because just mathematically, if you're doing price divided by early earnings, and earnings drops for at least a quarter or two, earnings went down dramatically as everything was shut down. So, and now the stock prices are back up. So this is probably going to climb a lot higher before it comes down again, and we get back into any sort of semblance of a normal valuation. So using this as a metric to value stocks or the stock market, um, you know, by this graph shows that it's pretty highly valued. Now, there are other ways to value the stock market that you might conclude that it is not quite so pricey, but this is the one that I've been using and looking at. So I look at it and I say, yeah, it's pretty pricey. So the next thing that I come to, and you might get the idea, I'm kind of building first an economic picture of what's going on before I start looking at the prices and the charts for the indices for the broad market, and then I will drill down from those and go into individual stocks or individual sectors. For this session, I'm just going to try and get through the economic indicators and look at the the technical indicators for the broad market and get through the main stock market indices. Then again, I can come back in later videos, and if there's anything you definitely want me to address, please leave a comment and let me know. And I know we can't meet in person, is very difficult in these times, but maybe instead of doing all the money shows and whatnot, we can leave the comments and produce the similar effect over the web. Okay, so what I'm looking at now is a website from the Conference Board, and they have even trademarked the term leading economic index for the US. And somewhere on here, if I accept their cookies, it will tell me here are all the things that they consider when they build up the leading economic index. So they're looking at manufacturing, they're looking at employment, they're looking at building permits, they're actually looking at the stock market itself, looking at credit, looking at the interest rate spreads. So they've got all of these different things that they are boiling down into one number, the leading economic index, which the name suggests that it's going to show its behavior before the stock market does. And I think there is something to that. That has been my friends and business partners at Delta Investment Management have investigated this leading economic index in quite some depth and found that it does have some predictive value if you look at its average over time and look at which direction it is pointing. So right now, the index is up. So that is pointing towards some wellness in the economy and the stock market. Now, the words around it say that despite recent gains, there's still difficulties, probably due to the pandemic. So there's something to take with a grain of salt on the leading economic index. So one of the things that goes into this is employment, and in the early part of the month, I look at that because this LEI gets released in the middle of the month. So some of the pieces and parts get reported along the way. And most recently, we had employment reported, and we had a big increase in employment with the unemployment rate falling only in quotes to 8.4%. So it's really good that it's improving, and it's good for people. It's good for the stock market. It's still at a pretty high level, so something to keep in mind there. So one other thing that I look at on the web, and this is getting to be more of a sentiment indicator. What I've looked at so far, I think I would class as fundamental indicators for the economy. Looking at this next one, the put-call ratio, this is more an indicator of investor sentiment. And as such, it is a contrarian indicator. So what the ratio is looking at is the number of bearish investors who bought puts versus the number of bullish investors who bought calls. So when most investors are bearish, this will be a high number. When mostly bullish, it'll be a low number. And then looking at this graph, there is a band of usual behavior. And when the value has wandered outside the graph and come back in, that has been a signal. So times where it has become so very extremely bearish and come back in has been a buy signal, including this past April of 2020. Everybody got really, really bearish, and then it came back in, and there's a buy signal. And well, look where we are at the right edge. Everybody has gotten bullish to the extreme. And when I say everybody, I mean, broad masses of people. These numbers show that there has been a lot more call buying than put buying. And it started to go the other way. There was some fear came into the market, and whoops, we had another run up to new highs. And then this is getting a little blurry here, but to me, it looks like this is starting to hook back towards bearishness. And we had, a couple bearish days the market coming down on Thursday and bouncing on Friday. And so maybe the key question as we look at the market price will be, is that the start of a turn or is that a pullback? And looking at this, seeing the extreme sentiment of wild bullish enthusiasm, when that turns bearish, that becomes a sell signal. So I would call this a soft sell signal, and look to see what happens as it crosses this line. Now, this sell signal, and there's a couple others that I'm going to talk about, we've been watching now for a couple weeks in my newsletter, Divergence Alerts. So subscribers there have had an early heads up on what to be alert for and where to watch for problems in the market. So with that, let's move to TradeStation and have a look at the VIX. The Volatility Index is plotted here along the bottom in orange, and up along the top is the S&P 500 as tracked by the SPY ETF. So a lot of alphabet soup, but this is a exchange traded fund which follows the big S&P 500 index. And so you can see how we've had a lot of movement up in the S&P 500 until very recently. We had a couple down and questionable days. And likewise in the VIX, it has generally gone down. So the VIX, what it measures is the volatility of the market. And it can be said, as far as emotions go, it's measuring the fear of the market. So there were times back, and I could spend probably a whole video on this, when the market was running up so nicely, the VIX was down under 12 and just kind of sitting there. And then as the COVID situation was heating up, this went screaming upwards to a high up in the 80s, and then finally came back down. Now, some people will look at things like this where it surges and comes back down and as a short-term buy signal. So from that perspective, what we had here as the market dropped off on Thursday, bounced on Friday, the VIX surged upwards and dropped back down. Now, what I would like to see for a happy market would be the VIX down below 20, and I'm not sure what it takes to get there. We had this pretty consistent up movement, and the VIX got down towards 20. It was in the low 20s, would not break that line. And then here we had the splash of fear. So anyways, that's an indication of the sentiment of the market as measured by its volatility. Another interesting market-wide indicator I like to look at is breadth, which shows us how wide is the participation of any rally or any downfall. And I attended a session by Tom McClellan, who is the son of the people who created the McClellan Summation Index. And he had done a lot of testing and showed pretty convincingly that looking for a divergence in the McClellan Summation Index is where you could find the most meaningful signal out of this indicator. So we've got one right here, and let me explain how I'm seeing it. Up at the top now in orange is SPY again. And building up from the bottom, I'm building up the McClellan Summation Index. And this is an indicator that I've built in TradeStation because I was having a hard time finding it anywhere. Now I've found a website. I may be moving over to that to look at. But anyways, I'm taking the advanced decline line and doing a couple operations to turn it into the McClellan Summation Index. And so you can see how this is moving with the price of S&P 500. S&P 500 hit a low, McClellan Summation Index at a low. As it came rising upwards, the price rose, McClellan Summation Index rose. And then as we get up to these more recent highs, what's the McClellan Summation Index doing? It is not rising as high as it was before in either one of these peaks. And see if I can make that a little easier to see, that this peak goes up higher than this one does. And then while we have the very clear new highs in the price, the breadth is falling off. So that is a sell signal. What it's saying is that fewer and fewer stocks are holding up this market index. So this is S&P 500 with 500 stocks in it, but they aren't all going up. We're seeing the breadth turning down, and it's fewer and fewer stocks. It's the Apple and Nvidia and Amazon and work from home, whatever has become a favorite lately. That's what's holding up the index, and the others may be headed downwards. And that's a very dangerous situation because you don't have as much redundancy. So as you get fewer and fewer participants pulling up the index, once those falter, and they eventually will, then the whole index goes down. So this may not happen right away. I think it's rare that we see such an extreme turn right after we see the negative divergence at new highs. But it is definitely something to be mindful of. Another quick indicator, this plot is looking at the spread between Treasury and corporate bonds. And you can see how, as the stock market falls apart, this dives really quickly. And so you've got to be on top of it fairly fast. And this is, I would call, a canary in the coal mine, that when this does take this cascading fall downwards, the market is in a free fall. So right now it's looking fairly stable. So even though we had a rough end to last week, and by the way, this is a weekly chart here. Every bar is covering a week of price action. So this is the open on Monday and the close on Friday, and a week of action in between. And during that time, the spread between the corporate bonds and the Treasury bonds stayed relatively stable. So the canary in the coal mine is still alive. That's a good news. And this is something I could come back and give you a lot more background information on in another video. But for this one, let's get to the stock market indices. And I have a list here in TradeStation where I can just click on the index and bring up charts, and I'll explain to you what's on these charts. So the first one is a weekly chart. I'm looking at the Qs for the NASDAQ 100, and I've got some trend lines drawn in blue here, things you can see where the price was following that before and hitting those bottoms, and how it broke that trend line in either direction during the COVID crisis, and then how this trend has been just running up. So if we had a new trend line tracing out along the bottom here, this would have kind of broken the trend and come back inside of it. So this, I would say, is largely an intact uptrend. And down below, I've plotted the MACD, the moving average convergence divergence. And that is something that I've already done videos describing, and you can see my YouTube channel to understand what this indicator is all about. But the main points here, I would say, here are the MACD lines. And we definitely do not have a divergence here because price has made a whopping new high versus this point, and the lines are up at a new high. So the fault that I have, and actually I have some software running that will turn colors, they'll turn red when a negative divergence is found. And the issue that I have with negative divergences is they make signals much more often than the market actually drops. So our stock markets are very resilient, and so even seeing some negative divergences up after this kind of run, I would be really more in favor of sticking with the trend. And at a time like this where we don't even see any divergence, I definitely would favor this trend continuing, at least until we see a repeat of the new highs here. And you'll notice that this is contradictory to what the McClellan Summation Index is saying about the S&P 500. Of course, this is fewer stocks, maybe some different stocks, but not all indicators are going to say the same thing. I'm going to move on to S&P 500, and then in this come down and talk about the daily chart. So what I should have mentioned probably on the cues was this first chart I'm looking at is again a weekly chart. So each bar is a week of trading activity. And again, we see with the S&P 500, we've got a new high. The MACD is higher than it was before. So it's saying it's supporting this price trend. Let's take a look at this daily chart, the S&P 500. And I've got this compressed pretty good. Let's open it up so we can see a little better. So a lot more stuff going on up here. Down below, this is the easy part. That's the MACD. Coming up here, the price is in yellow. And each of these price bars is 1 day of market activity. The large pink line is the 50-day moving average, and the bluish line is the 200-day moving average. So having the 50-day up above the 200-day, that says it's in kind of a bullish configuration. It's been running upwards. These other lines, these dashed lines, are a Keltner channel. And the fine gray line in the center here is a 20-day moving average. And I plot that kind of light because I don't want to get too caught up in it. But up above it, in the dotted teal line, is something that is 2 ATRs above this moving average. And by ATR, I mean average true range. So that's looking at the range of movement that each day's price has taken and averaging that out. So you can see there's this big gap. This was a big move day right before it. That's a small move day. You average all that together and multiply by 3. So this is kind of a measure of how far from the current price might one expect the market to go just in the course of its usual moving around. And this red dotted line below is the moving average minus the 3 ATRs. And this gives kind of a channel. You can do a couple things. One is you can measure the strength of the movement. So you can see how when the price was falling, it came right down along that channel line and it was hugging it. Then as it's been rising, now we've gotten, kind of lukewarm rise, and then it got up on the top of that channel and just ran along it. So that's very strong. The other thing it can show you is some insights into stop placement. So the average true range is often used as a stop loss. Someone might decide this is a buying opportunity and buying right here on the 20-day moving average. Their stop, a 3 ATR stop, would be down at the red line. So when the price comes and hits the red line, that has hit a lot of stop losses. And it may that's going to trigger some more selling that may bring it down more. So you can use that as a stop value. It might be kind of a popular place, and that may be not to your advantage to be putting a stop loss in such a popular place. Other considerations might be looking at the moving average, giving it the price a little bit of room to move under the moving average, because many people will buy at the moving average. So if a person had set a buy order on the moving average, might put a stop loss somewhat underneath it. And I think the final place that I would consider looking for stop losses is looking at the support and resistance. Is where was there a lot of trading going on, say right where I'm drawing this line, about 294.89. There was a point that the market hit several times. It had a hard time getting up over it, and then it came down onto it, but didn't break it and moved up from there. So something like that looks like an area of support. So you may consider setting a stop loss down below it. And so all of that kind of depends on what a person's goals and risk tolerance, how long you plan to let the position run. If you're going to do a longer term trade, you'd want a wider stop. If you're doing a shorter term trade, you've got to have a narrower stop, or you give up more than you can expect to gain. So there's probably a whole nother video in stop losses that I can make. There were some questions before this video, so I wanted to try address it a little bit. and I can come back in another more dedicated video. Okay, so looking at the S&P 500, one thing I would want to comment here is that, yeah, it did a pullback, but boy, it didn't even touch this 50-day moving average. So often when you see something change direction, like say coming back here at the start of the COVID crisis, um, it came to highs, it relaxed back down, came back up again. Ooh, now we got some more divergences. And then as it gapped down, it jumped below that moving average. And it went down and was able to gather some support and get back in here. And I call this kind of the Pong zone. The price may bounce back and forth in here a bit between these 50-day and 200-day moving average before continuing on the direction it winds up going. And so here we see on the way up too, it took some stutter steps here in between before it got itself up over all the moving averages. So those are the types of things I would look at here. And as I say, this is still up above the 50-day moving average, which is up above the 200-day moving average. So that uptrend is intact. Now I would go through here and look at the diamonds, the Dow Jones, look at the small cap, the Russell. This may be interesting. I'm going to pick and choose here. We're not going to go in detail on every single one of these tickers, partly because some of them are experimental in my looking at them, and partly because it's just going to get a long, dry video to stop at every one of these. But looking at the weekly chart of IWM, now IWM is small cap, so this is more active. It's a broader index also. I mean, there's 2,000 stocks in it of smaller companies. So this is where we see, when we talked about the McClellan Summation Index and a divergence on breadth, you can see this is not up at new highs. So when we're looking down at the MACD indicator, we're not really comparing highs here. This is showing us that the small cap companies have not been as strong as the large cap. And that is too bad, because the market is often stronger, or earlier in a bull market run, the small caps do better. And if you watch the previous video on ETF rotation, I said I found it better to rotate between small cap and large caps. And that's kind of why, because early on in a bull market, the small caps can really take off. And as the bull market gets older and later, the small caps are tapering off. There's not as much interest. Everybody's trying to get in the same thing as everybody else and look good and say, yeah, I hold Amazon or whatever the big winner is. And that's where we get these narrow markets that become vulnerable to a drop. So looking at the daily chart on IWM, for all that I said, it is still looking fairly like the bull is still alive here, in the sense that it's still above the 50-day moving average, which is still above the 200-day moving average. But I guess one other thing I would say is that, yeah, this is kind of low in the channel, so that's getting a little bit oversold. Makes me want to go back and look at SPY. Yeah, not quite so low in the channel here. There was more room in this Keltner channel for the price. Okay, so that's kind of stocks. Looking also at bonds, looking at AGG, which is all bonds. And sometimes this is like stocks upside down, but you can see that it's not nearly as volatile. And that, yeah, during the last week, we're on a weekly chart here. The bonds rose as stocks sold off, and then it came back. And looking at the daily charts, you can see there's just a whole lot of room in between the 200-day moving average and the 50-day moving average, and that the price is up here near the 50-day moving average. Now it's not looking as strong as the stocks. It's almost hanging underneath it like a bat in a cave, right? So it's not able to sit up above that 50-day moving average, which means it's pulling the average down. So that's kind of not as strong a direction for bonds. And bonds are often seen as the safety opposite the stocks. And we see a similar thing here. I clicked into TLT, the long bonds, and we see it on the daily chart falling away from that 50-day moving average. So it's looking like stocks are still the thing um, as we go through these markets. Now, I do also take a look at the US dollar as measured by UUP. So this is an ETF that tracks the dollar versus a lot of currencies. And you can see how the dollar has just been selling off, and now it's trying to find on this weekly chart here, it's kind of trying to find a bottom. But it keeps slipping downwards, and the MACD keeps slipping downwards. So that doesn't look all too strong for the US dollar. Looking at the international, and if you watch the previous videos with the ETF rotation, you'll see some very familiar tickers here. So I'm looking at the same tickers, but without the rules of the ETF rotation. So on the other one, I have very concrete rules of when to buy and when to sell and what would be the replacement if I sold. And in this sense, I am looking just to get a feel for what's happening. And so sometimes these things line up together, and sometimes they go opposite each other. And it can be very uncomfortable when they go in opposite directions. But it has kind of worked out for me because I go through this whole analysis, and oftentimes I'm wrong. I think the market looks like it's going to go one way and it goes the other. So it's nice to have something that is just looking at the numbers and just investing accordingly. And that also has some very well-defined sell signals, which enables me with my psychology to invest more, knowing I have a well-defined way to get out of the market. So one other area I'd like to look at here is gold, because that has been moving up even more strongly than stocks or the Qs. And it has persisted in moving up even when we had somewhat of a pull down or a pullback here during the COVID crisis. But then as the US stimulus came out, gold versus the US dollar has been on a tear. So now it's kind of relaxing back down from that unsustainable run, but it's still gathering support in this same place. And the MACD lines are supporting that up at new highs. So this looks like a very strong chart. And I should say I do own some gold in a safe deposit box and also in an ETF. So I'm looking at that with an eye of somebody who is long this instrument. Looking down here, there's a whole lot of different ETFs that follow different commodities. And I think that has some difficulties in creating the ETF. You sometimes see the effects of the ETF as much as you see the actual commodity. So for that reason, I don't want to go through them here. And the other one down here is real estate, and I would like to focus on that in more depth. I think real estate is very important, and I would like to focus on that in more depth in another video. So coming back on this, kind of get a status of the broad market, I now comes the really hard part for me, which is to bring it all together and come up with one summary and one thing that I can have in mind for the week to come. So I think that this breadth negative divergence is very important, and that between that and where's the put call ratio? This one. These are looming problems. These are market turns waiting to happen. So that is in the wings. And the thing that I've learned over the years is that you got to wait for it to show up in the price. And by show up in the price, I mean something more than just one down week. I think that, yeah, we could jump on that and maybe this is it. Maybe it rolls over like it did before the COVID crisis. But I think probably not. We probably get at least one more bounce up here where we start seeing even more extreme divergences on the MACD, where we see that put call ratio hook back in, and where we see the market putting together a downtrend. That's where I would look at this as being trouble and really get uncomfortable with the ETF rotation being in stocks and really be antsy to do something different. I do have some discretionary positions, and we haven't talked about individual stocks, but I am long some individual stocks. So seeing some of these sell signals is what would make me get going on selling those stocks. So I hope that this has been helpful to you. This is the sort of thing that I put into a write-up for the Divergence Alerts newsletter. There's also a big part of that newsletter that has to do with stocks that have divergences, as you might guess from the title. But I think that this market status is a significant benefit, and it's something that I am using more and more and getting more and more value out of than perhaps looking at the individual divergences on stocks. So I told you all this, give you an idea of what's in it. There is a sale on the subscriptions through Thursday. You can visit divergence-alerts.com and you can click for the subscription information, and then you get a chance to try and figure out what level would be right for you. So there's some sample newsletters and a table that shows you what you get with each level. And I think that bronze is ETF rotation only. Silver really focuses on that market commentary. And then gold and platinum get going on the MACD divergences on individual stocks and on the hourly chart for platinum, and doing more with trading the VIX. So that's kind of at the high end. And once you decide what level you want, you get to read these legal terms very, very carefully and hit the checkbox. I agree. And at long last, you'll come to a web page with PayPal buttons to subscribe. So I'm individual and have no capability of safeguarding anybody's credit card information and don't want to try. So I'm just going with PayPal is a convenient service to set up the subscriptions, and it looks like they've got some new modern buttons. So as the stay-at-home continues for me, I will have a chance to upgrade these buttons, and I can still accept Venmo and the old-fashioned paper checks or the Zelle QuickPay. If you would like to send it to me, drop me a line and we can work something out. Okay, so let's see. Thank you for your attention. And again, please comment on this video if you have questions or suggestions for future videos. And by the way, do take good care and please stay safe.